investors are borrowing more money to buy stocks than ever before. At the exact same time, they're buying record amounts of gold to hedge against financial collapse. Both can't be true. So, what are they actually afraid of? That borrowing is called margin debt, money borrowed against a brokerage account to buy more stock. FINRA data reported this month by Bloomberg puts the total at $950 billion. That's above the $936 billion peak set in October 2021, right before 2022's sell-off. Call it borrowed conviction, buying power built from debt, not cash. The easy read? A market brimming with faith in itself. Except this same pattern showed up in March 2000 and October 2021, both times right before the market fell. Confidence and leverage are not the same thing. So does a fresh record mean confidence, or does it mean investors have run out of their own money? Margin debt isn't some Wall Street curiosity. It sits inside the brokerage and retirement accounts tied to a $30.77 trillion US economy, according to World Bank figures for 2025. GDP grew 2.16% last year, a fine number until you notice how much of the buying pushing markets higher is borrowed rather than saved. That's the story this episode is actually about. Start with scale. $950 billion in outstanding margin debt is roughly 3.1% of that entire $30.77 trillion economy, nearly 150% larger than 2007's pre-crisis $381 billion, and more than triple the $278 billion recorded at the dot-com top in 2000, according to FINRA data compiled via Bloomberg and CNBC reporting. Every one of those three prior peaks was followed by a drawdown, not a rally. That's not a coincidence 3 times running. Margin debt now equals roughly 1.9% of the S&P 500's approximate $50 trillion market cap. A slow creep, not a sudden spike, which is exactly what makes it easy to miss. Japan's margin lending, by contrast, is widely described as a much smaller share of its market's total capitalization, though precise comparable figures aren't readily available. This leverage build is disproportionately American. Given that scale, why now? Unemployment sits at 4.2%, according to the Bureau of Labor Statistics, still historically low. And low unemployment tends to make households feel flush enough to borrow against a stock portfolio the way they'd borrow against a paid-off car. Under Regulation T, a brokerage account holding $500,000 in stock can borrow up to $250,000 against it, enough to double a position without selling a single share. Income concentration matters too. The top 10% of American earners hold 30.7% of national income, per World Bank data, and margin accounts require exactly the collateral most households don't have lying around. This is a wealthy household's leverage story wearing a market-wide headline, which is a little like reporting on national restaurant spending using only steakhouse receipts. Margin debt didn't hit a record in isolation. It hit one the same year the US Treasury confirmed federal debt had crossed $40 trillion for the first time. Government debt now sits at 115.77% of GDP, per the World Bank, up from 100.2% in 2019, a jump of roughly 15% in 5 years. CBO projections suggest that ratio will keep climbing over the coming decade, before any recession-driven stimulus is even added to the tab. The government's own balance sheet is leveraging up at the same time households are. Here's the tension. 10 and 30-year Treasury yields have climbed again in recent weeks, according to Reuters, even after the Federal Reserve moved rates lower. Normally, those two move together, not apart. To hold yields down, Bloomberg reports the Treasury doubled its bond buyback program in 2026, essentially buying back its own debt to keep borrowing costs from spiraling. Call it the safety net squeeze, a government trying to keep its own borrowing cheap while the market it might need to backstop gets more expensive to insure. Buying your own bonds to keep your own interest rate down isn't usually a sign of surplus confidence. Corporate buybacks tell a similar story. Companies spent $942 billion repurchasing their own shares in 2024, according to S&P Dow Jones indices, a figure that almost dollar for dollar matches outstanding margin debt, both leaning on borrowed capacity to lift the same market from two different directions. Then there's gold. The metal broke above $4,550 an ounce in 2026, according to CNBC and Reuters, a level that has, in the same stretch, outpaced several major equity indices. Central banks were doing something similar with a different asset. They bought a net 1,045 tons of gold in 2024, according to the World Gold Council, the third straight year above 1,000 tons. Stocks and gold rallying together is unusual. Gold is what investors buy when they distrust the currency or the government issuing it, not when they're euphoric about growth. So you've got record margin debt. Borrowed money chasing stocks, sitting next to a record gold price. Hedged money distrusting the whole system. Both can't be pure optimism. That's the paradox this leverage record is quietly sitting inside. Which raises the deferred question. If borrowing to buy stocks and borrowing to bet against the dollar are both spiking at once, what number actually tells you which one wins? History has an answer, and it's 15 years long. That answer is next. 15 years? That's how long it took the Nasdaq 100, tracked by the QQQ fund, which launched in 1999, right near that era's peak, to recover from a roughly 73% collapse after the dot-com bust, per historical market data. Many people holding margin debt today haven't held a brokerage account that long. That was true long before margin debt existed. Run the arithmetic on a smaller, more personal scale. A position bought with 50% margin that falls just 20% wipes out 40% of the investor's own equity, before a single dollar of broker interest is even added. The 2022 episode is the more useful case study because it already happened. Margin debt fell from the $936 billion 2021 peak to $720 billion in 2022, according to FINRA figures cited by CNBC, a 23% drop in a single year. That unwind worked like a home equity line called in against a house instead of a portfolio, borrow against rising value and the payments feel free, but let the value fall and the lender calls the loan before you're ready to sell. Margin calls forced selling first, regardless of whether an investor wanted to sell. Institutions with more collateral cushion absorb the shock more slowly. Leverage doesn't spread the pain evenly, it spreads it in order. South Korea offers a useful contrast. Margin lending rules there are widely described as tighter than in the US, and forced selling waves during that same 2022 downturn were reportedly smaller in the more regulated Korean market, though precise comparable figures aren't readily available. Tighter rules produced a softer landing. Borrowed conviction concentrates the same way income does. With the top 10% of earners holding 30.7% of national income, per World Bank data, and margin accounts requiring exactly the spare collateral concentrated at the top, the first wave of forced selling tends to hit wealthier, more market-exposed households first. American household net worth held in equities reached $56 trillion in 2025, according to Federal Reserve flow of funds data, meaning a modest downdraft moves real household wealth by hundreds of billions, whether or not the household ever opened a margin account. But forced selling doesn't stay contained. It drags down prices for everyone holding the same stocks, including the retirement accounts of households who never touched a margin account. Financial community discussion this year echoed on Reddit's investing forums, notes plenty of Americans still hold cash on the sidelines despite having the means to invest. Sitting out doesn't mean you're not exposed. It just means you didn't get a vote. That home equity line is worth remembering here too, only now it's drawn against a stock portfolio instead of a house. Borrow against rising value and the payments feel free. Let the underlying asset fall and the lender calls the loan before you're ready to sell. That's the mechanism sitting underneath the entire $950 billion figure, and it doesn't care whether the borrowed conviction belongs to a hedge fund or a retiree's brokerage app. The bill always arrives at the worst possible time. Layer the federal picture on top and the cushion looks thinner than usual. $40 trillion in federal debt is now larger than the combined GDP of China and Japan, the world's second and fourth largest economies. A comparison that has nothing to do with the stock market and everything to do with how much room the government has left to backstop lend. Debt to GDP at 115.77% per the World Bank is approaching, but still just below, the roughly 118% post-war peak the US reached in 1946. If a margin unwind ever required a policy response, the safety net squeeze becomes the whole story. The government answering that call is already the most indebted version of itself in modern history. The Federal Reserve's own balance sheet, still near $6.8 trillion, is roughly 60% larger than its pre-2020 size, leaving less room to expand it again without reigniting the inflation that pushed yields up in the first place. That is not the ideal moment to discover the safety net has holes. It would be easy to end there and assume a crash is already booked in. But the 2022 unwind is proof the amplifier doesn't always detonate. Margin debt fell 23% that year, and unemployment settled at today's 4.2% rather than spiking, according to the Bureau of Labor Statistics, a soft landing for the leverage, not a crisis. Household debt service payments at 9.8% of disposable income in 2025, according to the Federal Reserve, remain well below the 13.2% peak reached in 2007, evidence the broader household balance sheet carries more slack than it did heading into the last crisis. GDP kept expanding, reaching 2.16% growth in 2025 on a base of $30.77 trillion, according to the World Bank. The Federal Reserve had room to cut rates, and it used it. None of that erases the risk sitting inside a fresh $950 billion record today. But it does mean amplification isn't the same as inevitability. So where does this go? Put the three pieces together: record margin debt, a record gold price, and treasury yields rising despite Fed cuts. And the honest answer is borrowed conviction, not savings-backed confidence. The safety net is thinner than it was in 2021, federal debt is higher, and the Fed's balance sheet has less room to respond, so the unwind risk is real. The proof is in the same three signals: margin debt still climbing past $950 billion, treasury yields rising despite the Fed and despite doubled buybacks, and gold setting records at the same time stocks do. Nobody rings a bell at the top. The closest thing to one is a data series like this one. That's why you need to watch those three numbers. Because this time, the margin call might come to all of us, not just the traders. Thanks for watching. Mind your reserves. This video is for educational purposes only and is not financial advice.